Well, welcome everyone. I know we have a big crowd on here today, so great to have you all. Welcome to today's webcast. IRS enforcement of ACA is intensifying. What you need to know to avoid ACA penalties. So it is sponsored today by First Capital and presented by Joanna Kimbernetti. So before I turn it over to today's presenter, this webcast has been pre-approved for HRCI and SHRM credit. Please be sure to attend the complete webcast in order to receive your credits. You will receive an email from hr.com within 2 business days, which will include your certification credit information. You may also log into hr.com and go to your View My Credits page, where you can see the credits that you've received. If you have any questions during the webcast today, please click on the Q&A in your webinar controls and enter those there. A new tab is going to also open up in a new browser with an exit survey today, as I'll be sharing a link in the chat area to this as well as to the slides once the presentation has begun. All right, so before I turn it over to today's presenter, just a little bit about First Capital here. All right, so First Capital, founded in 1999, First Capital Consulting is a regulatory technology company focused on workforce data. We offer RegTech services for optimizing risk management and regulatory compliance, workforce management, data quality, and financial performance, all powered by the use of a proprietary data consolidation process. Our regulatory services include ACA compliance and pay equity auditing and analytics. Oh, that's great. So that's First Capital. And now it is my pleasure to turn it over to Joanna Kimbernetti.
Hi, good morning or good afternoon, depending on where you are. So, I suspect that a lot of you are familiar with the ACA Employer Mandate, and so some of the basic stuff I'm going to go over quickly. But there's some fundamental stuff that I want to make sure that we understand. We should all know what the employer mandate is, and that's essentially it's an obligation of all employers with 50 or more full-time employees or full-time equivalents. These are referred to as applicable large employers, or ALEs. ALEs are required to file annual information returns with the IRS and furnish certain returns to applicable employees. And these information returns provide information about the health care coverage that the employers are providing to their employees and dependents. Those that do not make the requisite offer of health care coverage, they can be assessed a penalty under Internal Revenue Code 4980H, which is often called an employer shared responsibility payment. Next slide. Now, the 4980H penalty, there's 2 aspects to it. There's the A penalty and the B penalty. The A penalty is basically failing to not offer at least 95% of the full-time employees and the dependents. So basically, what the employer mandate requires is that all applicable ALEs offer health coverage to at least 95% of full-timers and their dependents. And if you fail to do that, you're assessed roughly about $200 per month for every month that the employer fails to do so. Now there's the B penalty, and the B penalty is triggered on a per PTC basis. That is the premium tax credit that an employee might go on one of the exchanges, get a PTC, and so the B penalty is assessed on a per PTC basis. So if you had no employees getting a PTC, even if you didn't comply, didn't offer coverage or whatever, you wouldn't be assessed in a B penalty. The B penalty is only assessed on a per PTC employee basis. Now these are what's called the substantive penalties. Basically, these are the penalties for not offering the requisite coverage that the ACA requires. This is different from the actual procedural penalties, which is the filing and furnishing penalty. Next slide. And these penalties are under 6721 and 22 of the Internal Revenue Code, And this particular slide is dealing with businesses with greater than 5 million. The next slide will be less than 5 million. But the key thing is these are some significant penalties. So for purposes of like the next go-round of returns, you know, these are annual returns. They typically have to be filed at the beginning of the year, and they need to be furnished to the full-time employees and other applicable employees at the beginning of the year. These failure to do that on a timely basis, you know, if it's within 30 days, you're looking at roughly $50 per return. You don't do it somewhere between, if you file it late, somewhere between 31 and 31 days to August 1st, you're doubling that. And if you fail to do it after, by that August 1st deadline, you're, you know, almost tripling that. And if you actually fail to return it and the IRS deems that that failure was intentional, you're doubling that. So that's $540 a return. That is some big money. And mind you, if you have 100 full-time employees that should have gotten a return, you take that 540 and you multiply it by 100. It's a big figure. So this is not a trivial penalty. It's very important. Next slide. So this is these are the penalties for less than 5 million. And as you can see, the penalties are pretty much the same on a per statement basis. Now, the caps are different, but, you know, to say, well, my cap is only $500,000 versus, you know, being a cap being $1 million in penalties, you know, those are still, you know, the lower penalty is still huge. These are very, very big, you know, penalties for not filing the return. These are penalties, it doesn't matter whether you offered coverage or not. It could be that you offered everything that the ACA is required. If you didn't file the returns, if you didn't furnish them, these are the penalties associated with it. Okay, next slide. Okay, so, you know, there's been a lot of noise ever since the Trump administration came on board about what's going on with the ACA. You know, there's been a lot of repeal and replace, and that seems to have sort of ended with the well, what was famous was John McCain's thumb down when he had, you know, not gone with repealing it. And so there doesn't seem to be any efforts to repeal it at this point. Employer mandate, this is what I was talking to you about, the penalties for not offering coverage. Those penalties, that is the law of the land, and there's never been any noise about changing that. Now, there has been some, you know, as you may know, the individual mandate, that is a penalty to the individual for not having coverage. That's different from the employer's not offering coverage. The individual mandate penalty got zeroed out, which is basically, it used to be, I think last year it was supposed to be $695 per person, and then there was some variations for household size, but that got zeroed out. So basically, the penalty is now zero. And there was a Texas court opinion, district court opinion last fall saying that the individual penalty rendered the ACA in its whole, the 974-page statute, unconstitutional. There's a lot of legal punditry about that, but the prevailing view, including those from conservatives, is it's not going to withstand, it's not going to, the ACA is not going to be overturned. Importantly, even though this Texas District Court opinion had issued this remarkable decision, the judge, Reed O'Connor, also specifically noted that the ACA stays in place and will stay in place until and unless a higher court changes that. So basically, the status quo is the ACA is here. And so right now, I think they had oral arguments in the Fifth Circuit, that's the appellate court, looking at it, and again, the same buzz that it's not, you know, the whole ACA being eliminated is really not the prevailing view. So that's just prognostication, but it doesn't seem like it's going to make any difference. Another interesting thing, and I don't mean to digress too far, but what we're seeing also is, you know, with the individual mandate going away as of the beginning of 2019, what we've seen is the states are taking up the slack. So we've seen a handful of states, largely the blue states, that have gone ahead and created their own individual mandate. And the whole point, I think, of those who wanted to get rid of the individual mandate was to reduce the regulation. And what's happening is a reaction of more regulation, but on at the state level. So if you've got a business that's a multi-state operation, it's just becoming a bigger headache because, for example, in California, you're going to have to file returns, not just with the IRS with respect to the ACA, but also with the Franchise Tax Board, which is the California Taxing Authority. So it's just getting more and more complicated. Now you're dealing with a patchwork of different states having different layers, different rules that are being layered on top of the ACA. So instead of a one place, let's file everything here, now you're going to have to file it with every state that the ones that have passed an individual mandate. You're going to have to deal with those states' regulations to the extent the states apply to you. So while all that noise is going on, the IRS quickly mobilized and been starting 226J notices. They've already issued them for the 2015 year. We saw some scary penalties. I think the highest one I've seen is $22 million. So the 2015 notices have gone out, the 2016 notices have gone out, and now the 2017 ones we've heard that they are about to send them out very shortly. Now the IRS, this is, as many of the employers have complained about the employer mandate being complicated, trying to figure it out. The IRS too also needed to get their sea legs into dealing with the ACA. And so they spent a ton of money coming up with this automated ACV system in order to kind of automate that process. So the 2015 year was a little bit more clunky. So each year they're getting more and more efficient in identifying those who purportedly were not in compliance and generating out the penalties and cranking out these letters. They're just getting better at it. And in this process, they're focusing on the higher value work as opposed to a random selection process. The 2015 year, in large part, was a random selection process. The 2016, 2017 year, they're increasingly focusing on the ones where they can get sort of the biggest bang for their buck, if you will. And so, another thing that we're seeing is not only is the IRS getting better at enforcing the ACA, but they're also making them more stringent. So for the 2015 year, we saw the IRS being more willing to take less substantiated type responses where you're opposing the penalty. Now we've heard the IRS is like expecting to see documentation of how the full-time employees, for example, are being calculated. So they're just getting stricter because they're getting better at it and they're becoming more familiar with it. So they're stretching their, ACA knowledge muscle and coming after more employers. And this deeper scrutiny will mean that if and when, and it's these days it's more of a when versus an if you're an employer and you did not provide the offer of coverage required, trying to defend that is going to be harder and harder to do. Okay, next slide. Next slide. Okay, and as I had talked about, the additional sort of complexity, this gives you some of the states that have been putting up the individual mandates. And at the end of the day, the ACA, the whole concept is to, really kind of, I'll say, encourage employers to offer coverage. And if you don't do that, you are, facing not only federal regulations, but a bunch of states as well. And as to the extent that the federal government, through administrative changes, are chipping away at the ACA in terms of its impact, while that sounds good for those who don't have any interest in, in the employer mandate and the regulations associated with it, while that sounds good, the trouble is that the states are kind of reacting to that by coming up with their own. So it hasn't worked out the way that I think a lot of sort of deregulation type folks had expected it to be. So just expect it to get more complex. All right, next slide. All right, if we could launch the next poll question. Okay, so So the question is, have you heard of any of the following IRS communications on the ACA? And you can check any of these boxes. One is, have you just heard of the letter 226J? Have you just heard of the letter 5005A? The letter 5699? All of the above or none of the above? Rhonda, could you, I'm not sure how long the polling time frame is. You could let me know.
Yeah, I'm just going to leave it go for another 10 seconds, folks, so you can answer there, and then I will end the poll.
Okay, terrific. Thank you.
All right, and there are the results for you, Joanna.
Okay. So, yeah, this is about what I think that we've seen with our clients. That the letter that they've heard of the most is this letter 226J. And by the way, as part of our presentation today, we're going to go through all of the letters. But, interestingly, the vast majority have heard of none of them. And that could mean one of two things. One is that you've been compliant, or two, you just haven't gotten the letter yet. So that one's kind of like, it's hard to tell whether that's a good answer. I'm hoping you guys are the ones that are fully compliant, and that's why you haven't heard of it, because you haven't gotten it. Okay, we can go back. Next slide. Okay, so we're going to first talk about the 226J briefly, and as part of the PowerPoint today, all of these letters are discussed in detail, and you'll get copies of the presentation. So if I go too fast, just know that there's more meat in the presentation as well. So the letter 226J is a letter that an employer will get if the IRS has determined that the employer did not comply with a 4980H penalty. As you might recall, what I was saying early in the presentation is the 49H penalty is a substantive penalty for not offering coverage. So the letter 226J is a letter that says, hey, you didn't offer coverage, and now we're going to assess this penalty. You need to respond to that. So that's the 226J in a nutshell. Now, the 5005A, it always comes with a sort of Form 866A, which is an explanation of the letter. The 5005A is a fairly generic letter. But what the two of them do is say, you didn't file and furnish, and we're going to assess penalties because you didn't file and furnish. As you might recall, remember that was like $550 per return for intentional disregard for not filing the ACA information returns. Well, that's the penalty that goes with that failure. And so that 5005A is assessed. And as I said, it's a per return. So there's like a double whammy. If there's a schedule called the 1095C, that is the individual schedule for say the full-time employee. So if the full-time employee, if you as the employer did not prepare one and you were supposed to, you will get tagged a $540 penalty for intentional disregard for not having furnished it to that employee. And then you'll also get tagged a $540 penalty for not filing it. So it's like a double whammy if you don't do it, because you have to file it and furnish it. So so the 4980H is the failure to offer coverage penalties, and the 672122 penalties are for failing to file the returns and furnish them. And obviously, the size of the penalty will be determined in large part by the number of employees that were supposed to get these schedules. Namely, for most employers, we're talking about full-time employees. Okay, next slide. Okay, this one we can skip, but basically, we're seeing each year they're increasing the number of ALEs that they are sending 226J letters for, and the penalties, as I mentioned there, some of them can be really large, because like that A penalty, if you didn't offer that 95% coverage, you're going to multiply that roughly $200 per month, or I guess that averages out, that works out to about $2,400 a year. That is multiplied by all of the full-time employees. So that could be a huge number. Okay, next slide. So let's skip that, and I think we've covered that. And we can skip this one as well. My apologies. I've covered that. Okay. Next slide. Okay. So who are we talking about in terms of those who are sort of the greatest at risk? A lot of what makes the ACA information return complicated, well, there's also the coding in terms of what kind of coverage, affordability, minimum value, et cetera. But a important factor in complicating ACA information returns is the full-time count, because the penalties are largely based on the full-time count, the substantive penalty. And so when you have a workforce that has a really high turnover, one, that is going to be, you're supposed to keep track of who are the full-timers. And so that means that if you've got a lot of turnover, it's going to be harder to track them, and you need to do that accurately. And so you're potentially at greater risk when you have high turnover, number one. Number two is when you typically if you have an hourly workforce, there are these methodologies that the IRS provides for to determine full-time status. And one of them is a particularly valuable one for hourly high turnover. It's this method called the lookback method, but it's super complicated. And the real benefit of that method is if you do it right, you can hold off in offering coverage for an employee for over a year. So that's fantastic, especially if you have, healthcare costs for employees is the second biggest expense after salary. So this is a big spend that's going to affect the company's bottom line. And if you've got a highly variable hourly workforce that often turns over, they don't even last 6 months, having the ability to have this lengthy wait, it's not technically a waiting period, but it's basically this period where you are basically safe harbor from offering coverage. Having that cushion is really valuable. The catch is you got to use the look-back measurement method, and that requires, going back over a year in terms of payroll to run the analytics to determine whether or not they are measured as full-time for some prospective period. I know that you're like, well, how do I do that calculation? It's complicated, and that could be a session in and of itself. But it is a fantastic method for high turnover, hourly rate employees, but it's complicated. And so we have seen many employers try to use it, do it wrong, when the IRS tags them for it. And the rub with, an additional rub with the look back method is if you applied it and didn't do it right, that whole nice year, I think it's 13 months and change, that safe harbor period that you thought you were going to be able to take advantage of vanishes, and then now you get assessed for penalties right from the get-go. Okay, next slide. Okay, and as we talked about earlier, there's going to be less leeway in terms of responding to the 226J, in part because they're just getting more efficient at it, and they're getting stricter, and they're applying a more stringent standard. And then, on top of that, they've now announced that they are only going to allow one 30-day extension at most. So what we have seen is in the past, the IRS sends a 226J notice. We have seen extensions up to 90 days. That's all gone. If you get your 226J letter, the best you can hope for is a 30-day extension. And what we've seen is, they're now sending out the 226J letters, or they're starting on the 2017 letters. Well, so, gosh, it's in the middle of 2019. You now have to go dig up all the substantiation for the 2017 year, and if you use the look-back method, that means that you also need to go look at your payroll data for the 2016 year. So you're going back, way back, collecting all this information, and at best, typically the response deadline is 30 days from the day of the letter. Well, they send it on day one. That means 30 days later, and you're not going to get it the day they sent it. You're going to have maybe 25 days to respond, and at best you're going to have another 30 days. It's not enough time. It's very tight. If you get that letter, you need to start working on it immediately. Okay, next slide. Okay, so this is another poll question. If we could initiate the next poll. So the question is, what concerns you the most about responding to an ACA penalty notice from the IRS? So there's a number of options. One is having documented offers of coverage to refute the penalty assessment, not identifying employees correctly as full-time or part-time, not correctly applying the IRS measurement methodology. Mentioned before, there's that lookback method. There's also a monthly measurement method. Next one is not correctly calculating affordability. Next option is using flawed data for my IRS filing, not using the IRS coding properly, and I don't know. And you can check all that apply.
Okay, and we'll give it another 15 seconds, folks, and then I'll share the results with Joanna.
Okay, so we've got some, kind of a mixed bag in terms of all the different options, but the one that's the most, and not surprisingly, is not correctly applying the IRS measurement methodology. That is a very good concern. As I said, we have seen many companies that just don't do it right. This is complicated. There's some serious benefits for it, but it's very complicated. All of those that we've identified, those are all potential triggers for penalties. So every one of those is a perfectly good, legitimate concern that needs to be addressed. Okay, next slide. We'll close out the poll. Next slide. Okay, so a few slides ago, we were talking about the different types of IRS enforcement letters. So the 5699, that's essentially a precursor to the letter 5005A, Form 886A. 5699 letter is superficially kind of a simple letter. It just says, are you an ALE? And if you are, did you file it? If you didn't, when did you file it? If you did, when did you file it? If you didn't, when are you gonna file it? And then there's an option for I'm not an ALE. You cannot ignore that. If you ignore that letter, you're gonna get the 5005A. And they're gonna base, like remember we're talking about penalties based on full-time count? The 5005A bases it on W-2 count. Because they got the W-2 data. And I have yet to see a company where the full-time count matched the W-2 count. The W-2 count is always larger. And so if you ignore it, you're going to get this scary 5005A letter that says you're going to be assessed. So these are failing to file and furnish letters. And it's going to be based on W-2, and they're going to multiply it by 2 because, as I said, it's a double whammy. If you didn't prepare the form, you're going to get tagged for the failure to furnish and another penalty for failure to file. If it's intentional, we're talking about roughly $1,000 per employee. So that's a big deal. Next slide. Okay. So as I said, when you're responding, fill it out. It's pretty simple. If you plan on filing it or if you did file, it's a pretty simple letter to respond to. But when you get to 5699 letter, it's a fairly generous time frame to respond. If you haven't filed it, get your stuff ready and file, and tell them that you will file it within 90 days. Okay, next slide. Okay, so all of this, you're like, well, how did they even get this? Why did they send me a 226J notice? Why did they send me the 5699? Well, where all of this really comes from is the data that the IRS gets from the healthcare exchange. So you're an employer, you have an employee that received a premium tax credit through one of the government exchanges. This is in California, it's covered California. In those states that don't have a state-run exchange, it's through the healthcare.gov website. Now, these are folks that, for whatever reason, are not enrolled in your employer coverage. And they decide they're going to go on the exchange and they're going to go get coverage that way. And through the exchange, they can get what's called a premium tax credit. and that basically subsidizes the cost of healthcare coverage. The exchange then sends a list of all the PTC recipients to the IRS, and then the IRS compares it to the 1094Cs and 1095Cs. The employee does identify who his or her employer is. So the IRS has all the information to send you, the employer, a 5699 letter if you didn't file a 1094C and 1095C. Next slide. Okay. So how does the exchange notice happen? One of your full-time employees applies for healthcare coverage through one of the exchanges and receives a premium tax credit. Importantly, we have in this graphic, it's at least one full-time employee. That employee can fill out whatever the information however he or she wants. There is no, the employee could accidentally, erroneously, intentionally, whatever, could say that person was a full-time employee and didn't receive coverage from you, even though in fact you offered it. And so that exchange could be based on wrong information. Next slide. And you as the employer are going to want to respond to that, because you don't want the exchange to send out that list of PTC employees to the IRS if if it's not warranted. Now, there are these things called Section 1411 certifications. The original process was intended for the employers to receive the exchange notices first, and kind of you get sort of a first whack at addressing whether or not that employee should have received a PTC. And for example, if you had offered coverage and that employee had erroneously indicated that he or she wasn't offered coverage, that's the time that is a first opportunity to address it, and you never get the 226J letter at the back end. So unfortunately, some of the exchanges, and frankly most of the exchanges, have not done these notices, and so employers are like, what? I got this 226J notice out of the blue. I don't have a good answer for why the IRS has, or the exchanges have not sent out these notices, but they haven't. And the IRS has used the 226J as a proxy for that notice. And there's some questions as to whether they should be able to do that, but that's what they're doing. Next slide. Okay, and so here is a table kind of identifying who's going to be eligible. So let's say you have an employee with a household, let's say it's he's got a spouse and 2 kids. Well, that would be a household size of 4. And that means that, let's say his income is up to $103,000. That person could be eligible for a premium tax credit. And the reason why I point that out is the point is people making, what doesn't seem like, seems like good salaries, they are eligible for premium tax credit. It's very expansive. And so it's very easy to be eligible for a premium tax credit. You don't have to be below the poverty line. Okay, next slide. Okay, so here are the options. You can appeal it by basically responding, which we highly recommend, or you can ignore it and wait for the 226J letter. Now, as I said, there have been 226J letters where there were no exchange notices to begin with. But if you get the exchange notice, it's an opportunity to knock it out and never get the 226J letter. That's why we highly recommend it. Next slide. Okay, so if you're gonna respond to the exchange notice, what are you gonna do? It's in some respects very similar to the IRS 226J notice, except it's on a per employee basis. You want to identify, if possible, a basis is why that employee should not have gotten a premium tax credit because that employee, was in one of these safe harbors. And the key one is that employee was in fact offered coverage for the relevant time period, and it was affordable and met minimum value. Okay, next slide. Okay, so in the letter 226J, and we kind of talked about it more superficially, but what's in it? The 226J letter kind of puts like the boilerplate of sort of, what the 4980H penalties are, but there's sort of 2 significant tables. One of them is the SRP table, and it actually lays out on a monthly basis, whether it's the 4980 HA penalty or B penalty that it's based on and how it calculated. So it lays it out, and the way they got that information is, as I said, they got a list of who all got a PTC, and they also got your 1094, 1095C schedules. Now remember, if you didn't send the 1094, 1095C schedules, you might get the 5005A. If you then, in response to the if you in fact filed the 1094, 1095C schedule, then you may get subject to the 226J. If you never filed and you get a 5699 letter saying, did you file? If you did, when did you file? So on. If you didn't file and now you're gonna file, you can file that letter, and then following that you get the 226J, because they're like, oh, thanks for the returns. Okay, now you may not be assessed the failing to furnish or file penalty, but now we're going to assess you with the substantive penalty of not offering coverage. So they're independent. The penalties are independent, but just because you fix one doesn't mean you fix the other. Okay, next slide. Okay, so this is just kind of an example. Like 2015 is, for the large part, mostly like really not an issue. I think most employers have already dealt with 2015. But the key thing between 2015 and the subsequent years is that threshold. In 2015, the offer of coverage rate was 70%. So if you offered employees 80%, you offered a coverage to 80%, let's say it was net minimum value, was affordable, you would have zero penalty. Let's say one full-time employee didn't meet that element. Your entire B penalty would be $3,120, and you would have no A penalty. So, bottom line, your penalty would be $3,120. Next slide. For the 26, 27, 2018 subsequent years, that same fact pattern, you would be potentially assessed a $1 million penalty. And that's because of the 95% threshold. Okay, next slide. Okay, so when you get the 226J, as I said, they give you a 30-day deadline to respond from the date of the letter, so you probably have 25 days by the time you get the letter. You can seek one 30-day extension at most. And you can agree and say, yeah, I'll pay that $1 million proposed penalty that you are proposing. You could do that. You could just do nothing. You're going to get a collections notice after that, so I really recommend not doing that. And then if you disagree in part or in full, you're going to want to respond in that timely basis. Okay, next slide. And when you're responding, you're going to basically justify why you shouldn't get a penalty. So you're going to have to understand the employer mandate and how it applies to you and how you comply with it. So with regard to, for example, on the full-time calculations, you're going to have to explain what your methodology is or was, how you calculated it, and then what the corresponding code corrections are. When it comes to the affordability, you're going to have to establish what safe harbor you use. There's, federal poverty level, W-2, rate of pay. There's different safe harbors. Which one you use, what your premium rate was, what was the employee's salary or hourly rate, depending on which methodology you use, and why it complied. So it's complicated, and you want to document all of that. Now, in earlier years, the IRS is basically, like for the 2015 year, they've indicated, oh, we don't need the documentation, but they want you to spell it out in a response. But even if they don't want the documentation, you want to have that ready. So if they say, well, I'm not really sure I agree with your response, let me see your documentation, you can do that. And when you submit your response, you want to say, if you want to see the calculations that get to these figures that I've provided, here it is. Because then the IRS is going to know that you have done your homework and you can prove what you're saying. And you need to sign the statement. Okay, next slide. Okay. In terms of the supporting documentation, as I said, the IRS, at least in the early year, have not wanted to actually see the documentation. They just want you to spell out what it all says. But you want to, regardless of whether you actually submit it, you're going to want to have that ready. and the kind of things that you're going to want. Obviously, the FT calculation, how you came up with that. And if you are saying that it nets minimum value, for example, you know, the summary of benefits and coverage, that is the easiest thing, because right there in the standard SBC form, it'll say this plan meets minimum value. So you're like, well, see, here's verified. In terms of making the offers of coverage, we show you an example. Another way, you know, you could potentially provide that is an enrollment guide that shows that all employees who, you know, work at the company to get offered coverage that shows who was eligible. And so that's an indirect way of saying, well, we offered it to all full-time employees over 30 hours per week, which is the way the ACA had chosen to define full-time. Next slide. Okay. So if you disagree, and here are the kind of errors that in terms of responding, like what you want to pick at. The wrong FT count. That is a huge, huge thing to look at, because that's what triggers the magnitude of the A penalty. So you want to look at, well, if you use the monthly measurement method, was it correctly applied? Same deal with the look-back measurement method. Now, as part of the 226J letter, you get that ESRP summary, but you also get a form, which is called a PTC listing. And it identifies every alleged employee that got a premium tax credit and for what month, and the codes that you had provided on the 1095-C form. So you want to compare the codes. It's basically you checking if you did the 1095-C codes right. And if you did, that'll be a way there was no penalty associated with it, that's a way to reduce the penalty. Or if you did the code wrong, it's an opportunity for you to correct that code and reduce the penalty. We have seen employers that had filled out the 1095-Cs correctly and the code corresponded to no penalty, and yet the IRS still imposed a penalty. So this response statement is an opportunity for you to say, hey, you know, respectfully, there was an error in the IRS's letter. You know, our 1095-C schedule said, you know, whatever the code was that corresponds to a safe harbor, and we were assessed a penalty, you know, that should be eliminated. So on. Next statement. I think next slide, sorry. So now we're switching over to the 5005A in terms of how you respond. With the 5699, which is a precursor to this letter, at least in theory, you know, you're basically, it's a simple form. The 5005A, the main thing that you can address is the penalty number, which is, as I mentioned, the W-2 count. And if you do nothing, you will get assessed, and you'll get that notice of collection that you are going to, the IRS is going to assess penalties based on the W-2 count. So that's, I can't imagine a scenario where a good answer is to just go ahead and pay, because it's going to be wrong. It's always going to be wrong, unless you are in that rare instance where your W-2 count is identical to your full-time count and you didn't file, you know, you have no sort of defense to that. Next slide. Okay. And so here's like, if you don't respond to anything, they basically, you know, these penalties are subject to IRS lien and levy enforcement actions and interest accrued, and that interest is not trivial. It is, I can't emphasize enough, do not ignore these letters. Next slide. Okay. Now, with regard to IRS representation in connection with the ACA, you can have someone, you know, like you go through for example, the 226J process, but there's also an appeals process if you propose something different than the IRS, and even though you responded with your disagreement, the IRS nonetheless refutes that, and you now want to take it to the appeals process, you can be represented internally, and you can be represented by a third party qualified in that process. You know, obviously you want someone who has expertise in the ACA, doesn't have to be an attorney or a CPA in connection with the ACA information return. Next slide. Okay, so here we have another poll question. If we could launch that next poll. poll question? Anna, can you put up the, oh, thank you. Okay, so which of these makes organizations vulnerable to receiving ACA? 1, a high percentage of full-time employees. 2, a workforce that often declines offers of healthcare coverage benefits. 3, low staff turnover rates. 4, reliance on payroll systems or other software systems to submit the ACA schedule. And 5, I don't know.
All right, and again, just another 10 seconds and we'll end the poll and let Joanna know.
Okay, so I think we're done with the poll, and the vast majority, 70% of you say a workforce that often declines offers of health coverage benefits. And at least from what we've seen, a high percentage of full-time employees, yes, that's definitely not one that's a less likely causing vulnerability. The declination of offers of healthcare coverage is certainly one of the biggest ways to make a company vulnerable to penalties. Another big way is payroll systems that automate the ACA return. And I'm going to talk about both of those quickly. So when a workforce that often declines coverage, these are typically high turnover workforces, hourly employees that often don't last more than a year. And as I mentioned about the lookback method, how that can be very handy to address that kind of coverage, that kind of workforce. A workforce that often declines, that means you're going to want to prove that that person was offered coverage and that person had declined it. So if you've got like a sort of revolving door of employees, that means you're going to track all these declinations of coverage, make sure it covers the full year at issue, and you're going to want it in some kind of centralized location so that 3 years later, when the IRS comes a knocking on this, you are ready to deal with it. And that's really challenging. And, and if it's done by paperwork, which it often is, sort of managing that and making sure it's complete is really challenging. With regard to automated preparation of the 1094, 1095C form, the problem with that is a lot of these software solutions, they do these sort of default settings. They tend to be the worst setting. Like, for example, we didn't offer coverage. That's the default setting. So it's up to you as the employer to go into that system and fix that. We've seen a ton of employers that have gotten the 226J letters because the automated system that they had used had just filled in the default setting, which is a conservative setting, AKA I'm going to get penalized setting. And it's up to you to fix it and say, no, we did comply. We did offer them more than 95%, or at least 95%. Okay, so I'm going to close out this poll, and we can go to the next slide. Okay, so, if you haven't gotten a 226J letter or a 5005A 886 letter or the 5699 letter, it doesn't mean that the IRS isn't going to send it to you. And what's worse, the IRS could just be slow at it, and that just, memories really fade, and where all the documentation is, starts collecting dust, and maybe it's not collected. It just makes it harder. The whole idea of the sort of risk exposure analysis to figure out, well, did we do it right? And if we didn't, what is our risk exposure? So it's information for you to know and deal with however, accordingly. And so, taking a look at your 1094, 1095C, checking the accuracy of the full-time count, because if you get the 226J letter, you're going to have to do that. And so knowing that it was done right now is better, because this is, the longer you wait, the harder it is going to be to do that calculation and making sure you have all the data for that. And if it's payroll, you're talking about payroll data from years ago. Do you still have access to that? That's a big question. Okay, next slide. Okay. Now, the good news is the sooner you can fix these errors, you're ready to deal with it. And the IRS, you know, from what we've seen, if you're able to really substantiate why those errors existed and they needed to be corrected, they've accepted that. So having the ability to do that, if you just say, hey, you know, I shouldn't have been assessed a penalty, that's going to fall on like a lead balloon. Spelling it out, saying, hey, this is the way we calculated it, and here are the results. You can, you know, if you want to see the calculations available for IRS review upon request, here's what our results were. This code means this code means that, and therefore we are not exposed to any penalties. They're going to accept that, but you need to substantiate it. Okay, next slide. Okay, now, next slide. Okay. Now, another thing was nice about, I was talking about the sort of risk exposure assessment, you know, it really kind of identifies issues that your, whether it's your HR department or whatever department that's handling ACA compliance, it gives you an opportunity to see sort of what the holes are and how you can fix it on a going forward basis. The ACA is not going away, at least not in the foreseeable future, and, you know, if the federal government somehow gets rid of the employer mandate, which really has never been an issue, it's been other issues with the ACA, you can bet that the states are going to rise to the occasion and create their own employer mandate. So, you know, basically it's as simple as it's going to be. It's only going to get more complicated. So being ready to deal with it is really your best bet. Okay, I think that is, next slide. Okay. So, you know, on our company website, we have a pile of information that if you want to know all things ACA, 226J, 5005A, we got it. So we have these resources available, and I think you can link onto them in the presentation if you want to check it out. So we have a little bit of time for questions, so let's get into those.
So lots of great questions coming in here, Joanna, and I can read out a couple here for you in the next few minutes.
Okay.
Yeah, so first here from Ryan. Ryan says, can you say again what the 5005A form is?
Okay. What the 5005A form is basically a letter saying, oh, you didn't respond to our 5699 letter, or you didn't file 1094, 1095C forms, and we think you should have. And because of that, since we don't have a full-time count from those forms, we're going to rely on the W-2 count to assess the 6721 and 6722 penalties, which is the failure to file and failure to furnish the 1094, 1095Cs. That's the one that I was talking about earlier about the double whammy, where you're looking at $1,000 per person. That's a lot of money. And if you didn't file it for a year and you were supposed to for 1,000 employees, that's, the math is not that good, but I'm guessing that's $1 million bucks. It's a lot of money. So that's the 5005A form. Next question.
Question here from Heather. Have you heard of any specific reporting for the states that are creating individual mandates? This came in quite early.
The answer is no in terms of specifics. I believe California and New Jersey, they're both contemplating, they are talking about filing a return with their respective state organization. I know California has specifically said that they are going to issue regulations to spell out what those forms are going to look like. I believe New Jersey basically says you can file a 1094, 1095C or some equivalent of that with the New Jersey taxing authority. So it's still new. I think these are returns that are going to be due next year. So, you know, we'll see in the next 6 months what regs come out, what new, you know, publications are issued in terms of what the forms will look like. But at a minimum, you're filing something else, you know, preparing something else. Okay, next question.
All right, question here from Dan. After responding to and contesting a 226J letter, how long does it typically take for the IRS to respond?
That is a great question. We have seen a few weeks. We haven't seen anything more than a couple months. But, you know, from sort of anecdotally, I'd say a few weeks to a couple months is probably the range. And there's about 5 different responses the IRS can give, and they're all numbered. Like there's a 227K, 227L, 227M, and I forget what the other 2 are. But there's one, and I forget which one goes with which, but there's one that's, you don't got to do nothing, we agree with you. That's the best one. And it's like a boilerplate letter. It says, you don't have to do anything, you are not assessed a penalty. That means that you hit a home run with your response. There's another one, and again, I don't remember which letter it corresponds to, but there's another letter that says, we don't agree with your response, but we're reducing the penalty because you made some good arguments in it, essentially. And that's not as good as the other one, the home run, but it's still a pretty good response. There's a third response where it's, no, we don't agree with your response. We're just going to assess the final penalty based on our original 226J. And then the other 2, I think one is a variant of we need more documentation, and I forget what the 5th one is, but it's one of those kind of typical expected responses. Next question.
Okay, great. And from Michael here, when you have variable hour employees and you do the proper 60-day look back for when they are hired, what is the criteria for moving throughout the year to figure out if they become full-time? We were told to do 6-month look backs to calculate whether they become full-time. Is this a safe method?
You can do a 6 that's, you know, it's hard to really give a thorough answer on the look back because the look back method has a bunch of, well, you got to assume A, B, C, D, E, and those A through E need to be compliant with the look back rules, and assuming that, then you can answer questions. So if you have a 6-month look back, which in of itself you can do, I believe your stability period cannot exceed so you can have a stability period of 6 months if you're going to have a look back of 6 months. So I don't know if the question is, can you have a 6-month look back period? The answer is yes. But if you're going to have a 6-month look back period, there's some additional rules you have to comply with. One is that you need at least a stability period. You can only have a 6-month stability period. Those rules and how the like administrative period works and whether or not you have an introductory period, those just because you have a 6-month look back period doesn't mean you're compliant. What a 6-month look back period means is you can do that, but provided a bunch of other things. So it's hard to answer the question. And we have some resources in our website that has some information about that might be more useful. And if you have, you can send me an email and I could try to address a more full discussion of your question if that would help. I believe my email information is on the website and we can get into that, but it's hard to kind of answer your question. But you know, the short answer is you can have a 6-month look back period. Okay, so next question.
All right, I think we have time for one more question here. So Shannon asks, we sent our 22-6J letter response with corresponding backup in December 2018 for tax year 2016. We have not received a response. Should we be worried? We sent it via certified mail and have a signed receipt that it was delivered. Thank you.
You know, the 226J letter has a phone number that you can call. If you got the letter from the Kentucky office, it's a little bit more convenient in that I believe the agent that's assigned to you, they give you that person's number. But given that it's been quite a while, I think it's worth contacting, because what I'm concerned about is the IRS sent some letter, let's say hypothetically saying, no, I don't agree with you, but for whatever reason, you didn't get it. It is not uncommon for people not to have gotten a letter because they don't send it by certified mail. So, you know, or could have gotten lost in your mailroom, I don't know. So it seems way too long. Like the IRS, I'm surprised that they haven't responded. So I would really strongly encourage you to contact the IRS and see if they had submitted a response. Like I said, Kentucky, that's a little bit easier because there should be like a direct contact information. If you're coming out of Ogden, Utah, you're going to have to call that. It's really kind of a 1-800 number. You might get the runaround. We've certainly done that where we've called them and they've kind of been bounced around, but be persistent and you will get to someone eventually. And, you know, I'll tell you, I've been on the phone for an hour waiting for somebody to transfer me to the right person. It's just, it is what it is, but I would strongly urge you to follow up. And if the penalty amount is allotted, it's most certainly worth doing that. Okay, I think that was it for the questions.
Yeah, that's great. So we're at the top of the hour here, so we'll have to end the presentation now, but there are a lot of great questions still, and the team at First Capital will definitely make sure they follow up with you folks. So thanks so much for being very interactive. So as well, thanks to First Capital for sponsoring, and Joanna, thank you so much. What a great informative webcast and lots of value to the members here, so we thank you. And a very special,
thank you.
Yeah. So a special thank you to those for joining us today. And as far as your credit, you will see that in your account within 24 hours. You can take a look at hr.com for that. If you would like to view this webcast again, it is available in the archives for up to 7 days for those of you with free memberships, and without restriction if you have a recertification membership, an HR Prime membership, or an HR Genius membership. So if you don't have one of those and you'd like to view all kinds of great webcasts like this, please take a peek at that. And your feedback is important to us, and as well, it is important to First Capital. So if you could take a moment to just fill out the exit survey as we end here today, that would be much appreciated. So any closing comments there, Joanna?
No, just thank you for your time. And if I could just say anything is take these letters seriously. That's all I can say. Okay.
Absolutely. All right. Thanks so much, everyone. Have a great rest of the day.